Get ready to find your recipe for a successful real estate lifestyle from America's top experts here at Greenlight REI with your host, Lance Edwards.
Well, hello everyone. Hi, this is Lance Edwards. Welcome to this session of Greenlight REI, where we cover the successful real estate lifestyle. And we have a guest today on a topic that is of interest to everybody: is where's the money coming from? Where's the funding come from for these multifamily deals? And this gentleman has a lending product which is very, very popular. You're about to discover why. But first of all, let me bring it on. His name is Mr. Jack Pomerantz. Jack, welcome to Greenlight REI.
Thank you for having me. Happy to be here.
Jack, you deal in an area known as small balance loans for multifamily. And so I thought it might be interesting if you could kind of, well, first of all, I do want to tell everybody your background. How did you get into small balance loans? And then what are small balance loans? And we'll start there.
Sure. So, again, thanks for having me on. I guess we'll start from the beginning. Born and raised in Atlanta, Georgia. Went to college in Alabama. Went to Auburn. Studied finance with a commercial real estate minor. My mom was a real estate agent growing up, residential. Just kind of grew up in real estate. So knew I kind of wanted to use my finance background and my love of real estate to try to find a job. Knew I didn't want to be an accountant. Didn't want to do marketing. So just kind of lined up naturally. Ended up getting a job out of college at Walker Dunlop, which is who I work for now. I started out as an underwriting Fannie Mae and Freddie Mac loans, large institutional loans, $50, $100, $200 million deals, all over the country. And then about 5 years ago, I pivoted more to the sales side of the business, bringing in my own book of business for clients that need financing for either acquisitions of their multifamily properties or refinances. And I kind of fell into the small balance platform. So what defines a small balance loan? So again, everything I'm going to talk about is going to be geared towards Fannie Mae and Freddie Mac, because Walker Dunlop, who I work for, we're a direct lender. So I'm a direct lender of Fannie Mae and Freddie Mac. In Fannie Mae and Freddie Mac land, small balance lending are loan amounts from $1 million to $7.5 million, and everything in between. So, whether we're talking about an 8-unit deal that's $1 million loan or a 150-unit deal that's a $7.5 million loan, we do it all in that space. And the good thing about Fannie and Freddie is we lend in every single market across the country. So not like your local banker who only, can do loans in your backyard. I do loans in Seattle, Texas, Georgia, middle of nowhere, Tennessee, prime New York City. We do it all. It's all non-recourse debt, no personal guarantees, all 30-year amortizations. It's what a lot of the largest institutions in the world use to finance their buildings. This is the small balance arm that got created about 10 years ago. So happy to answer a bunch of questions about it. I'm sure everyone's going to have questions, but that's kind of just a quick synopsis on it.
All right, very good. So you actually opened up some doors there. So that's what let's kind of dive into the attractor factors of these small balance loans. You mentioned some of them. Is of course, first of all, it's multifamily specific, correct? These small balance loans.
Correct. And so that for the Fannie Freddie small balance, all for stabilized multifamily apartments.
Okay. Minimum $1 million up to $7.5 million loan amounts. And the balloon and the terms are up to 30-year amortization. And then what are the balloon terms on these loans, Jack?
Yeah, so it's all 5, 7, or 10-year terms. So it'll be a 5, 7, or 10-year term with a balloon payment at the end, but the payments are calculated on a 30-year amortization.
All right, that's excellent. And I heard you also mention non-recourse. So talk about the non-recourse and how that works. That's always of interest to people.
Yeah, so a lot of local banks, credit unions, you have to sign a personal guarantee, essentially meaning if you default or the loan goes under, they can come after you personally. On a non-recourse loan, all they do is take back the property. Now, no one wants to default or get foreclosed on, but it's nice knowing that if that happens, the worst thing that can happen is you just have to hand the keys back to the bank. So no personal guarantee. You will sign what's called bad boy carve-outs, which pretty much means the only way a personal guarantee is triggered is if you commit fraud, essentially, is the only type of personal guarantee that's on these non-recourse loans. But it's as non-recourse gets.
All right, that's excellent. And what type of LTV are we talking about on small balance loans?
Yeah, so we can go up to 80% LTV, but in the agency world, you'll hear me say agency, which just means Fannie and Freddie. We're in-place cash flow lenders, meaning we're going to look at the current in-place income, the current expenses. Now, the expenses can be modified slightly based on your budget expense comps, because a lot of times sellers are running properties fat, whatever it may be. But we're going to look at current income and then kind of underwritten expenses that can be supported by an appraiser, expense comps. And then we're going to see what that NOI, the net operating income that we come down to, where you can cover at on a debt service coverage ratio. So the debt service coverage ratio is typically going to be anywhere between a 120 to a 135, depending on leverage, market, a number of factors. And so you can go up to 80% leverage if you have enough DSCR room, right? And now in today's world where interest rates are elevated, your day one going in cap rate needs to be very high to get 80% leverage, right? I tell you that for the majority of deals that we're seeing are around, call it 6 caps going in. And for 6 cap going in, the base of what we're seeing today is around 65 to 70% leverage. I say that's kind of on average what we're seeing. But, I do some business in the South Side of Chicago. In the South Side of Chicago, you're buying true 8 caps day one. At true 8 cap, you can go up to 80% leverage. So the short answer is 80% leverage. The long answer is all that info I just gave you.
I got it. So let me kind of recap there for everybody. So it's up to 80% LTV, but what probably is going to be the deciding factor is your debt coverage ratio has to be limited, and that's going to specify what the maximum leverage is that you can get.
Correct.
All right, I understand that. And all right, so with small balance loans, of course, you can use these for acquisitions and can use them for refis and can use them for cash out refis.
Yes, you can. So acquisition, refi, cash out refi, all of the above. A few things to note. If you've owned the property over 2 years, there really is no limit on how much money they'll cash you out as long as the property appraises for what it's appraised for and there's enough support. If you've owned it for under 2 years, they'll look at your loan to cost, right? So they'll look at what you bought the building for and how much capital you put into it. And they'll look at, what the new loan is. Are they going to give you all of your money back? Maybe. Are they going to give you all of your money plus some back? Maybe. Just you have to look at that calculation. And then if you've owned a deal for under a year, the other thing to note, I'm just giving you a lot of information here, is that let's say you bought a deal 7 months ago, you've turned around operations, you've doubled your NOI, the property value has gone way up. That's great, but we're only able to lend off of your cost basis. So what does that mean? So let's say you bought the deal for $2 million, put $1 million of CapEx into it, so you're in it for $3 million, but you've increased income so much that's worth $10 million now, right? I'm just making up numbers. If you've owned it for over a year, that means we could lend off of that $10 million new appraised value. If you've owned it for under a year, it means we have to lend off of and value the property based off your cost basis, which in this case would be the $2 million you bought it for, plus the $1 million of CapEx. So that's a big thing to know for people that want to cash out a lot of money. You probably need to own it for over a year before you can really do a substantial cash out and be able to go off the new appraised value.
That's still a pretty short time frame. I mean, just to have to hold on to it for a year to get that's pretty good. That's pretty good. Okay, so those are the loan terms. Any other loan terms we have not discussed that people find very, very attractive with this small balance loan product before I talk on
the only other thing to mention is that we provide a lot of interest-only payments. So you can go sometimes the full term of the loan, sometimes for half the term of the loan, but going years at a time without paying any principal down, just interest-only payments to maximize cash flow. So I'd say the bulk of the deals that I do have, call it half-term IO, so a 10-year deal, 10-year term. In the first 5 years, you're only paying interest. For lower leverage transactions, you can get full-term interest only, so 5, 7, or 10-year term where the whole term you're only paying interest. That's a real benefit where a lot of our outside competition can't really compete with that because they're not providing any interest only. So when it comes to maximizing your cash flow, we have a lot of interest only options, which can be very, very, very beneficial.
And I imagine it's quite popular right now with rates being high, like they
exactly
make the deals
That's exactly
work.
Right. Because a lot of people are like, Jack, I'm currently paying, I don't know, $475. But if you're paying $475 amortizing, meaning not interest only, paying principal and interest, then my $550 interest only rate, I'm actually going to lower your payment. right? So the interest only is very important when you're comparing it to whether your current payments right now or whatnot. So a lot of the deals I'm doing are call it cash out refis, where they're able to cash out money and then also get them into a full term interest only loan where maybe they don't love the rate just because rates are elevated, but they're going from paying a fully amortizing loan to a full term interest only loan. So it kind of gives them the best of both worlds.
Well, that was going to be my question. So if you're trying to get your LTV up, you could do it. You'd go interest only to get your payment down so you can help squeeze in the debt coverage ratio. Is that right?
It's a very good question. The short answer is no, though, because even on a full term interest only loan, we still have to calculate the DSCR on an amortizing basis. So even if it's a full term interest only loan, it's almost like a stress test. They're going to make you still calculate the DSCR on an amortizing basis.
Got it. Okay, got it. All right, so let's recap the loan terms. Non-recourse between $1 million and $7.5 million, 30-year AM, 5, 7, 10-year terms, LTV up to 80%, but it's probably going to be dictated by debt coverage ratios, so you're probably going to do less than that in the current environment. And you can do it for acquisitions, refis, cash out refis.
Correct.
Very nice. All right. Okay, so that's the loan, that's the attractor factors. So what requirements are around the property to be eligible for this product, Jack?
Sure. So the biggest thing, I guess, only multifamily properties, self-storage, hotels, short-term rental type assets won't work, just for multifamily. It's for stabilized multifamily properties. What does that mean? We want physical occupancy of 90% or more. Right. So, if you're trying to buy a heavy value add deal that's, it's got a bunch of delinquency and it's only 50% occupied, it's not going to work. I tell them, hey, get a bridge loan, go to a local bank, stabilize the asset, and come to me for the refi. So they want 90% occupancy for 90 days. We call it 90 for 90. So by the time we close the loan, they want 90% for 90 days. So typically I tell guys, once you can bring me a deal that's been stabilized at 90% occupancy for a month, and you have a strong T1, strong trailing one on your T12, bring me the deal. Then by the time we close the loan, plus or minus 60 days later, you'll have that 90 for 90. So that's the biggest thing. Minimum number of units is 5. That's what's considered multifamily in the Fannie Freddie world. So at least 5 units. That's really it in terms of property. Again, any market is fine. Whether we're talking New York or a small town in Texas, primary, secondary, tertiary markets, we can do it all.
So are there literally no market exclusions?
None.
Too broad of a statement.
No market exclusions. Now, your terms might be lesser in a middle of nowhere tertiary market than in Dallas, right? So they might make you go to a lower maximum LTV, a lower minimum DSCR, but they will lend in every market across the country.
Okay, and with your business, are you strictly the small balance loans, or do you help people get into mezzanine as well and then take them out?
Yeah, it's a good question. So my real value to my clients is in the direct lending capacity, right? So in Fannie Freddie world, right? Because I can serve as a debt broker, but I don't have as much value when I'm a debt broker as when I'm a direct lender, because I really facilitate the whole process. I am the lender for all intents and purposes. So I'd say 80% of my book of business is in Fannie Freddie world. I do a lot in the small balance, but I do much larger loans as well. My team last year closed a $60 million loan, and we closed $1 million loan, then kind of everywhere in between. But I do put on my broker hat for some of my clients and, help them find bridge debt, pref equity. If it's ever they're buying an industrial deal, I can do that. So the short answer is I do it all, but my real bread and butter and the real value I bring is as a direct lender for Fannie and Freddie.
Well, thank you, Jack. Let's talk about that, because you're using the term direct lender. Help explain that to everyone and why that's important to them and how that's a special value you're bringing to the process here.
Sure. So to get Fannie or Freddie debt, you have to go through what we call seller servicers. And there's only, it depends on the program, but 8 to 10 companies that are seller servicers of Fannie and Freddie, because you can't actually go to Fannie Mae or go to Freddie Mac. You have to go to the direct lenders, the Walker Dunlops of the world, the CBREs, the Arbors. And why that's important is there's a number of reasons why it's important. One, I'm as close to Fannie and Freddie as you can get. You can't get any closer. So we're limiting the number of mouths that have to be fed on a deal. If you go through a debt broker, you're going to have to pay the debt broker, and then my team has to get paid as well, and we have to split it with Fannie and or Freddie. So that's one, cheaper. Two, it's streamlined. You limit the game of telephone. If you go through a debt broker or someone that's not direct, you have to call him and ask him a question, and then he's going to have to call me to get the answer. It's a lot easier if you just get rid of the middleman and the client just calls me direct, right? Especially because that's what I do all day long. And then the third thing is that there's been quite a bit of fraud in the marketplace recently, and mostly for broker deals, meaning getting agency debt through a debt broker where they're not direct. And so because of that, there's additional hoops that Fannie and Freddie require the borrower to jump through when you're not going through a direct lender and you're going through a debt broker. You can still get deals done, but just slows down the process. So you put all that together, it's really a no-brainer to go direct. It's always been a no-brainer to go direct, but now that there's been that fraud in the marketplace and additional hoops, it makes even more sense.
And that's good. And it would seem to me, are you doing the loan underwriting in your office? Are you guys really the one? So when you say it's approved, it's approved. Is that a
correct?
Fair statement?
We have it's a good question. On the Fannie Mae front, our company takes the primary risk on the deal, not Fannie Mae. It's our company that takes the primary risk. So everything is from Walker Dunlop approval, essentially. There's certain things you have to touch Fannie about, but for the most part, we're the ones that make the decisions. On Freddie Mac deals, Freddie Mac takes more of the risk. So we are somewhat more at the mercy of Freddie Mac and their decision making, but we work with them all day long, that we know how they think. So you ask me a question, I already know what Freddie Mac's answer is going to be. So not quite as much delegated authority on a Freddie Mac deal, but still, it's as much authority as you can get going direct.
Okay. All right. So that's the property requirements. Let's recap that. So 90 for 90, need 90% occupancy for at least 90 days, but you can start the process before that, because by the time you close, that you'll satisfy the condition. You mentioned the debt coverage ratios. There was a ratio you gave, 1.125. You give the debt coverage.
Yeah, it'll be anywhere between a 120 in a top market for Freddie SBL. So Freddie SBL, that's Freddie's small balance, is all market based. So there's top markets. So for top markets, think New York, Miami, Dallas, Seattle, some major MSAs. And in top markets, you get the lowest pricing possible, lowest interest rates, and you can go to a 120 DSCR, which is a huge benefit. In standard markets, think Nashville, Atlanta, markets like that, you get the second best pricing Freddie SBL has to offer, and you have to cover at a 125 DSCR. Then you have small markets where you have to cover at a 130. Then you have very small markets, very small, think very tertiary, very small towns. You have to cover at a 140 DSCR. And so the DSCR will be anywhere between a 120 and a 140. Fannie Mae, most deals are either a 125 or a 135.
Got it. Okay. All right. So those are the property requirements, and those fall in our sweet spot because we're doing quote small apartments. So we've got that covered. All right. So we've covered the loan terms, the property requirements. Okay. Now let's talk about the borrower requirements, if we could, Jack. So I'll let you just start. What are the borrower requirements, and I'll ask from there.
Sure. So the requirements are so there's an experience requirement, and then there's a financial wherewithal requirement. Let's start with the financial wherewithal. This can be on a combined basis for the individuals that are signing on the loan, right? So you can have more than one person signing on the loan. On a combined basis, they want net worth equal to loan amount and liquidity equal to 10% of the loan amount. So let's put some numbers on that. Let's say we're giving you $1 million loan. They want your assets minus liabilities that you can put on a personal financial statement to be equal to $1 million at least. Again, it can be between two people, 500K and 500K. That'll work too. And then they want liquidity, so cash or stocks or bonds, not retirement accounts. Retirement accounts do not count towards liquidity in Fannie Freddie. That you can prove out through statements equal to 10% of loan amount. So for $1 million loan, call it plus or minus $100,000. Again, that can be on a combined basis. Most people can meet that. Some can't, but that's where I don't have that being the bigger issue most of the time. The bigger issue is the experience piece, especially in small balance world where it's someone's first deal. The black and white experience rule is they want you to have current GP ownership, not limited partner. You're the real managing member in the deal. You're the sponsor. They want you to have GP ownership in 3 apartment buildings, one of which you've owned for 2 years or more, or GP ownership in 1 apartment building, but you've owned it for 5 years. And that's where it can be tricky, right? If this is someone's first deal, Jack, I have the net worth, I have the liquidity, I don't have the experience. Okay, what do I do? What you do is you partner with somebody that has the experience, right? At least on your first couple deals. You guys take it down together, you're co-managers in the deal. The person that's signing on the loan with you is going to need to have the managerial authority, or at least be a co-manager, because he's the one that has the experience on paper. And you guys sign on the loan together and do that for your first couple deals until you have the experience, and then you go off on your own merry way. I've done that a bunch where, a lot of my clients starting out, Jack's only my first or second deal. I'm going to have a partner for these first couple years, and now he does large deals all by himself because he's grown. So those are really the requirements. If you're close on some but not quite, can you go in for a waiver to get it approved? Sure. But just the black and white, plain experience and net worth liquidity requirements are, as I just said.
Got it. Okay, so let me repeat that. So on the because I got a question that came out of that. So they want to have the borrower's net worth to be at least equal to the loan amount. And for that net worth, you can't use retirement accounts. What about somebody's home equity? Do they count that as an asset?
You can use all of your assets and all of your liabilities will count towards your net worth. The retirement accounts won't count towards liquidity.
For liquidity. Got it.
Correct.
Okay. All right. And okay, so we have that net worth requirement. You have a liquidity requirement, and of course, they can partner with someone to help on that as well. If you have a gap of whatever amount, they just need to be a co-borrower on the paperwork or the co-applicant. How does that?
Correct. And they need to have some skin in the game and be a co-managing member of the deal, right? They need to have some authority as well. So I'd say be co-managers of the deal.
Okay. So any other requirements from the borrowers? Because you didn't mention credit score or anything like that. I didn't hear.
Yeah, no. So we don't need any tax returns. That's good. That's one. Minimum credit score is 680. So they want a 680 credit score. Obviously, we'll run a credit check. Want to make sure there's no real skeletons in the closet, no past bankruptcies, no past foreclosures, no ongoing lawsuits, stuff like that. But as long as you have clean credit, have at least a 680 credit score, and meet the net worth liquidity and have the necessary experience, you'll qualify 100 out of 100 times.
Okay, so this sounds very formulaic in terms of the underwriting process. So you can know what you got a high probability of qualifying for the loan or what you need to do to meet the requirements. So maybe walk me through. I don't know. Is there a type of deal that you guys see over and over that's be a great example, and especially if you lean towards my group probably more towards getting their first deals done, just coming out. Maybe if you could share. If a case study comes to mind, Jack, that would help paint a picture of the process and the type of project and the individual.
I think the number one reason deals don't work for Fannie and Freddie is because the property is not fully stabilized. Maybe it is stabilized. It's at 91% occupancy, but the delinquency is through the roof. Concessions are through the roof. Expenses are through the roof. Could we get a deal done? Maybe, but it's not going to be at a leverage that makes sense for you, right? So it doesn't have to be a totally clean deal. I don't want people to think, Jack, this is a value add deal. It's not going to work for Fannie and Freddie. Value add's fine. We want you to bump up rents, but it needs to be a stabilized deal that has some real day one cash flow, right? Because we're looking at your day one cash flow to calculate the DSCR. So if you're like, well, yeah, they've been, they are at 90% occupancy, but they're only collecting, 70% of the rent that's actually due because of delinquency, it's probably not going to work just because the DSCR is not going to work. So, I don't want people to think, well, we plan to renovate a bunch of units and bump up rents. I guess it's not ready for agency. That's not the case. You can renovate units, you can bump up rents, but it needs to have some day one cash flow, right? That will give you the necessary leverage and is clean enough that I could show to Fannie and or Freddie to get it approved. So the biggest thing I'd say is typically just a property that's not really quite ready for for agency, or maybe it will be ready, but let's wait 2 or 3 months until we can see that stabilize. They kicked out the bad tenants, they got rid of the concessions. Now they're operating at a much better pace.
All right. So, Jack, what questions have I not asked that I should have asked in your world?
It's a good question. It's a good question of which question to ask. The only other thing I'd like to make clear, Fannie and Freddie is all about providing financing for affordable housing. Their whole charter is to provide financing for affordable housing. What does that mean? It means that for properties that are deemed affordable to tenants, you actually get discounts on your interest rate. So, for example, a Class B or a Class C deal that has below market rates will actually get you a lower interest rate than if you bought a brand new Class A deal in New York City that has top of market rents. Even though that's a clean, pristine deal, that's great. If Fannie Freddie does lend on that, it's not where they can give you major rent rate discounts. So we have an affordability estimator spreadsheet that we run where we look at the current in-place rents and compare it to the average area median income. And based on the in-place rents, if they're deemed affordable, you can get major discounts on your rate. Call it up to 50 basis points off in your rate. So it's beautiful for a lot of clients that are, playing the Class B, Class C value add space, because you get the discounts on your rate for day one having rents that are low, but then you can turn around and increase rents the next day the loan closes and you still get that benefit of the lower interest rate, right? So it's a real synergy between these, syndicators, whatever it may be, that are buying value add real estate with below market rents. You're getting the interest rate reduction and you're getting the benefit of that. But then we want you to increase rents day one. We want you to do your value add program. Your rents, there's nothing that says, hey, your interest rate's only going to stay this low if you keep rents this low. It's not like a deed restriction, affordability restriction like that. We just look at what your rents are at the time that the loan closes, and if they're deemed affordable, you're going to get major discounts on your interest rate. So that's just something I like to make clear about how Fannie and Freddie work.
Well, I'm glad you said that, because my members are mostly looking at workforce housing. It's this Class B, Class C, value add stuff. And you're talking about these small properties, it's mom and pop owned and operated when they got it, and they've never raised the rent because they'd hate to lose Mildred. And there's a rent bump just moving in there. So that's our sweet spot.
Yeah, I would tell you, we can certainly do a lot of other deals than this, but this just like, you send me this deal, it's like my eyes light up, like, oh, this is perfect. A mom and pop owner operator that's actually done a good job operating, but hasn't raised rents for 10 years because they're best friends with the tenants, right? It's a clean deal. They collect all the rent. Expenses aren't bad. The rents are just super low. It's 100% occupied. It's been 100% occupied for forever because it doesn't push rents. Perfect deal. Perfect. That's it's gonna be easy to get done. The financials, it can be mom and pop accounting. That's fine. We'll figure that out. But it's a stabilized deal. Just has really below market rents. Perfect. That's a beautiful deal.
Yeah, that's our world. You're discussing, Jack. That's great. That's our world.
That's it.
All right. That was a great one. What other jewels you got that I haven't asked about? I should have been asking about. It comes to mind.
I'm trying to think if there's anything else I really want to mention. So I guess let's talk about Fannie Mae versus Freddie Mac. Which one makes sense versus the other? So Freddie SBL, let's talk about the benefits of Freddie SBL. The benefits of Freddie SBL are twofold. One, you rate lock at signed application. So I send you the term sheet, I send you the application, you sign on the dotted line, your rate is locked. So in the market we're in right now, where the treasury is going up and down every day, it's very valuable. So if the treasury goes up 100 basis points the next day after you sign the app, doesn't matter. Now, the inverse is true as well. The treasury goes down, we can't lower your rate. Your rate is locked, it's not changing, which 9 out of 10 times is a good thing, but want to make that clear. I view that as a major strength of Freddie SBL. Two, Freddie SBL is the only program within Fannie and Freddie world that offers prepayment flexibility, meaning Fannie Mae small, and then Freddie big and Fannie big, so we're talking larger loans. All of those are yield maintenance or defeasance, which pretty much,
Mm-hmm.
maybe that's another call, what yield maintenance and defeasance mean, but pretty much means that you don't have great prepayment flexibility. You need to hold it for the term of the loan, or at least close to, or else you're going to pay an arm and a leg when you refi or sell. With Freddie SBL, they offer step downs, accelerated step down prepays, where you're only going to pay a percentage of the outstanding balance loan amount every year. So year one, it could be 3%, year two, it could be 2%, and then 1% the last 3 years in a 5-year term. So for deals where you really want to be able to get in and get out, either cash out refi or sell after 3 years, for Freddie SBL can make a ton of sense because they have that prepayment flexibility. So those are the two benefits of Freddie. What's the benefit of Fannie? The benefit of Fannie is, one, you can close quicker. It's a quicker process than Freddie SBL. Fannie Mae, you can close and call it 45 to 60 days. Freddie SBL takes more so 60 to 75 days. So it's quicker. You can get more interest only in Fannie Mae. So if you do a 65% leverage loan and you cover at a 135 debt service coverage ratio, we can almost always provide full term interest only. So a 5, 7, or 10-year term where you're not going to pay a cent of principal the only time, only interest only, which is beautiful. And in Fannie Mae, my team has a little bit more authority. We're not at the mercy of Freddie. We're not at the mercy of Fannie. In a lot of Fannie Mae deals, my internal team can make a lot of credit decisions and help get deals to the finish line. The downside of Fannie Mae is that it's all yield maintenance, right? You don't have the prepayment flexibility. So if you take a 7-year yield maintenance deal, you probably need to hold it for at least 5 years or so, or else you're going to pay an arm and a leg. Now, a lot of it is dependent on what happens with interest rates, but just something to keep in mind. Now, the only thing I'll say is all Fannie Mae and all Freddie Mac loans are assumable, though. So what's the best prepayment flexibility? Assumable loan, right? So if you bought a deal this year and you look to sell in 2 years and your loan is still attractive for an incoming buyer, they can assume it. And then you pay 0 prepayment penalty. So that's a huge benefit there as well. So any deal you guys send me, I would look at it, Fannie and Freddie. I'd send you both quotes and talk through which one makes more sense for your business plan specifically. But there's pros and cons to both, and just a conversation we have that's varies depending on the investor, their equity, their investor base, their investment time horizon. A lot of things go into that decision.
Excellent. All right, excellent. All right, Jack, how do our members avail themselves of your services? How do they get in contact with you?
Yeah, so you can call, text, email, and I will almost always respond. So I guess we can put my contact info maybe at the in the comments or at the bottom of the link whenever you post this. But you shoot me an email, you shoot me a text, you give me a call, and tell me about whether you have questions or you have a deal you're looking at. Let me know. My team will turn around a soft quote, a soft debt indication in a matter of typically 24 hours. All I need is a T12 and a rent roll to provide you with a soft quote. And then from there, we can talk through, all the various options there are.
All right. Well, Jack, go ahead, and for people that are listening to the audio on whatever platform they're listening to, we'll go ahead and give them whatever contact information you wanted to have.
Yeah, so cell phone number, the best number to reach me at is 678-699-0628. That's my direct cell phone number. They can call or text. And then my work email that comes to my phone, I'm always available, is J Pomerantz. So JPOMERANTZ at WalkerDunlop.com. That's WALKERDUNLOP.com. Any of those phone call, text, email, I'll be sure to respond in a timely fashion.
All right, let me repeat that for everybody. So it's Jack Pomerantz, Pomerantz, right, Jack? I got that right?
Correct.
And mobile number 678-699-0628. And
Correct.
his email is, like his name, J Pomerantz, Pomerantz at WalkerDunlop.com.
That's it.
And small balance loans. Jack, this has been outstanding. You covered a lot of ground in a short period of time, kept it concise. But is there any final bit of wisdom, final bit of advice that you would share with, again, my listeners are folks that are fairly new to the small multifamily space, maybe done some deals, looking to scale up, do some deals. Any advice for them?
Yeah, I would say getting into Fannie and Freddie sooner than later is very smart. I'm obviously biased, but there's a reason that the Blackstones of the world, the largest owner operators in the world, use Fannie and Freddie for almost every one of their deals that are stabilized multifamily. And the fact that Fannie and Freddie have this small balance arm for smaller private investors is something you need to take advantage of. Now, having a partner on your first couple deals is paramount. I think hopefully that's where you can come into play. You need to be willing to partner up with somebody to get Fannie and Freddie debt for your first couple deals. But getting your foot in the door where Fannie and Freddie know you and trust you as an owner operator, as a borrower, will only help you down the road to start getting better and better terms. And knowing that you have Fannie and Freddie and you know the process, you know what your terms will look like, is going to help you win deals as well. Because sellers and brokers want to know that you can get the financing, be able to tell them, yeah, I've already closed 2 Freddie SBL deals and a Fannie Mae loan last year. I think is a huge selling point to help you win deals. And it's not easy to win deals right now. So again, I'm a bit biased, but I think getting into Fannie and Freddie and getting that under your belt sooner than later is really paramount in today's world.
Yeah, I'm gonna add to that. Everybody listening, Jack was describing, talking about you get a discount on the rate for quote affordability product. That's workforce housing. That's our sweet spot. That's what we're doing. And the situation he described, where mom and pop have been operating for years, haven't raised the rent in forever, but they got this high occupancy because the rents are so low.
Yeah.
That's our sweet spot. And if you can create a machine to do it using Jack's products, and you need a partner, I may be able to help you out there with regards to some of the borrower requirements. So I think it's a sweet opportunity. Jack, thank you again so much, man. This has been fantastic. So everyone, get a hold of Jack Pomerantz for your lending needs on these small balance loan properties. Thank you, Jack.
Thank you, guys.
You've been listening to Interview with the Experts with Lance Edwards. Let us now blatantly and shamelessly bribe you toward creating your own real estate lifestyle by offering you a whole bunch of free stuff. Go to greenlightreinvesting.com and get you some free stuff and this session's show notes. That's greenlightreinvesting.com.